Now, our next guest is among those economists who expects growth will pick up in the new year, though not nearly as much as it usually does after recessions end. Michael Englund is the chief economist for Action Economics, which provides real-time economic analysis to bond and currency traders. Bloomberg ranks him among the most accurate forecasters for the economy overall and for GDP. Michael, thanks so much for joining us. Michael, you predicted that GDP would rise 3.1% in the third quarter, way above the 2.6% we actually saw today. What do you think is holding these numbers down?
Well, you know, the flow of data over the last month suggested an upward revision, and all the components we looked for upward revision in actually did post that big boost. Unfortunately, service consumption, which is about half the economy, we have really no monthly data for. We have to wait for each GDP revision, and unfortunately, this last round of revisions were downward. So we still got a headline boost. We still went to 2.6. And if you look at the broader picture, we'd say there's pretty erratic swings in the quarterly data for the last 2 to 3 quarters. Really no pattern. People in the summer thought we were going through a low. That original flash estimate was for 2%. At 2.6, it's really not that different than the 1.7 in the second quarter and 3.7 in the first, which is really a 2.7 average for the first half of the year.
Now, I believe you do have some strong views on QE2. It certainly has been controversial. Do you think that's been helping or hurting recovery efforts?
Well, you know, I think people that were promoting the QE2 concept really were focused on the stimulative effect of acquiring securities, essentially the pushing on a string phenomenon that economists model with monetary economics. Unfortunately, when it comes to engaging in these kinds of dramatic policy moves, the public reacts to them. Many people in the bond markets have not liked the idea of the government buying these large quantities of bonds, which they're going to have to deal with through the second half of this cycle. It's really not clear what effect it's having on private demand. And when they announced QE1 a couple of years ago, what we found was yields hit bottom on announcement. People wanted to trade the announcement effect. But within about 2 months, yields had risen 100 basis points. And interestingly, now in December, yields are up about, over the last 2 months, about 100 basis points. Pretty much the same pattern as the last time the Fed tried this game. Has
the Fed actually, Mike, gotten itself into a position where it kind of has to do this? Otherwise, the market would be disappointed. It seems like people traded the announcement here as well. You know, it was already priced in. And in effect, the pricing into that helped the economy. But if they didn't do it, the markets would be so disappointed.
Well, yeah, I think they're going to have to carry through the $600 billion in purchases. I think the real problem was when the Fed trial ballooned this program a couple of months ago, it was pretty clear there were cross currents in the marketplace. I think the benefits from QE2 were always going to be limited. And what the Fed should have done is tried to assess whether it could really sell this program to the public at large. And there are a pretty broad cross-section of financial investors who are concerned with what the Fed's going to be doing to the second half of the cycle. So I think on that sales pitch front, the Fed probably fell a little short.
Let me ask about the tax cut compromise. What do you think about that? Does that give a really big boost? Because some people have called it, PIMCO called it massive stimulus.
Yeah, I think this is actually going to have a visible effect on the first and second quarter economies. The payroll tax cut was really the surprise that came out of this deal. It's going to add $60 billion to the annualized income numbers right out the chute on Jan 1. I think the result's going to be some very solid retail sales numbers in January and February. We're looking for GDP to kick up to about 3.5%. Certainly short of a healthy expansion, but certainly better than what we've seen through much of 2010.
And Michael, I see you're forecasting 3.4% for GDP growth next year. Is that still realistic with these numbers that we've seen today?
Yes, I think we have a pretty solid trend, in fact, through the fourth quarter. If you look at a lot of the fourth quarter statistics, the sales numbers were picking up in October and November. So I think, you know, looking at this fourth quarter number, some people have highlighted a 4 handle. We do think the number is going to come in at around 3.5, as will the first quarter. So I think by the time we get to February or March, we're going to have a pretty clear 3.5% trend in GDP.
I wonder if you think the tax cut compromise actually carries through some effects to the fourth quarter. I mean, there was so much talk about uncertainty that was putting off decision making and money spending. Does that get started right now? Does it get started as soon as we learned about the deal?
Well, that could be the case. You know, the payroll tax cut really caught the market by surprise. That was just a week or two ago. So I think it's probably unlikely the fourth quarter data is going to pick that up. Also, it's worth noting we tend to track sales statistics in the economy, but actually we're interested in production. It's really hard for producers to gear up production in response to a policy change. So I'm guessing it's really January, February, March. We're going to see a pretty even spreading of production increases associated with the payroll tax cut, even though consumers read the paper, and it could be that there'll be a strong close to the holiday season as people look ahead to a tax cut in January.
If you're concerned about the long-term effects of QE2, and we've already seen interest rates kind of start to march up on the 10-year here, why would you be so bullish on the economy in 2011? I mean, 3.6% is not bad.
Well, I think the upside potential for QE2 wasn't all that great in the first place, and I think the downside potential, as long as they cap their purchases at $600 billion, probably won't be that significant either. If you look at QE1, yields rose about 100 basis points. They stayed high until the Fed quit buying treasuries. After that, yields fell. My guess is if we look 6-7 months down the road, if the Fed does adhere to its end of second quarter deadline, we probably won't see a net effect on the economy from QE2. Our concern about it is that the sales pitch probably did produce the result that any positive benefit we'd have gotten from it has probably been lost. But looking forward for the economy as a whole, I don't think that this quantitative easing strategy is really going to be a big player in where we are in this cycle.
Mike, let's talk about Treasury yields. These yields we're seeing continue to march up. If you're so concerned about QE2, how high do you think these yields are going to go? Are we going to see 5% by the end of 2011?
Well, I think we very well might. I think the problem we have with Treasury yields is that we have seen a broader two-year flight to quality to the U.S. Treasury market, alongside what has been a spectacular increase in the size of the U.S. budget deficit. My guess is with or without QE2, we'd have been seeing a climb in sovereign debt yields in the U.S. over the next couple of years. What I think will happen is at first we may be seeing a spike now into the start of the year. We may see a fairly flat pattern through the year, but as this expansion matures, I think a 5 or 6 handle on Treasuries would not be unreasonable, and that's what we're looking for about 2-3 years down the road.
Does the Fed react? I mean, does QE2 then get expanded? Do we see QE3, even if you think it's a bad idea?
Well, my assumption is there's enough discourse in the market now about the problems with QE2 that the Fed will take the hint. And as we start to approach the end of the second quarter, which is their deadline, and I think the real pressure will come probably at the March FOMC meeting, the Fed will show its hand that it's going to reassess this program and probably start the rhetorical sequence that will allow a natural end to this program in June. The Fed does a biennial testimony first in February and then in July next year. And I think the program will be behind them in July, and they're going to be focused on an expansion rather than their attempts to mend the recovery from the very deep recession.
How concerned are you, Mike, with the deficit? I mean, it doesn't seem like there's going to be much headway in, well, definitely not in cutting spending, and obviously they're not raising taxes. So what kind of concerns do you have going forward, and how long do we have until it really becomes a serious problem?
Well, I think the deficit is going to be the one big lead weight that will be hanging on the U.S. economy for the next 4 to 5 years. Right now, we're focused on a recovery, and we're focused on the rate at which the economy is coming out of this recession. But by the end of this cycle, the real key is going to be what happened to productivity growth trends in the U.S. economy, and what sort of trend growth are we seeing in GDP. And that's where I think the real cost of these large budget deficits will come. Probably 2 to 3 years down the road, we are going to hit crisis conditions where the market will start to punish the Treasury for issuing so many securities. For the near term, we probably won't see it, but the longer term risk is, of course, similar to what we're seeing now in Europe with Ireland, what we saw earlier with Greece, and what we're going to be seeing in Spain and in Italy over the coming year.
All right, thanks so much, Michael Englund of Action Economics.